Hey guys, what's happening? This is Chris from Verillo Trading. Hope you guys are doing good today. So I want to make a video talking about trading and talking about some typical patterns and pitfalls that happen within traders that I think the market is designed this way to make traders do certain things. And I want to talk about these things that happen a lot. I've experienced this a number of times. It almost feels like I'm repeating the same story over and over again, but I need to talk about this because traders who don't really know what they're getting into, they need to hear this. And also experienced traders, I think you guys will relate to this to some degree or not. So I'm gonna demonstrate some patterns that occur in trading. I also want to know your thoughts on this, so feel free to leave comments and whatnot. And what I do want to say before I start this video is that it's very easy to philosophize trading, to come up with conclusion after conclusion as to why something happened or why something could have happened. And honestly, what I am going to say is that you have to keep it simple, guys. Trading is not that complicated. Keep it as simple as possible to avoid getting into these negative tendencies and thought patterns that are going to get you to essentially blow your account in the long run. This is by design. The market is designed this way to make traders behave a certain way. All right, guys, if you enjoy this content, leave a like. Let's get to it. Here we go. Okay, so let's talk about some tendencies that happen in the marketplace first of all. Okay, so when you get into the market, this is you, all right? And you look pretty happy. Now, when you start trading, you're probably going to have some success, especially if you have some good principles you're following, you know what you're looking for, you have a good mentor, you have a good education. You're probably going to do pretty well for a few weeks. And I've been this guy a number of times. And you do well for a few weeks, maybe even a few months straight. But what tends to happen over time is your mind gets slowly corrupted, and then you become this guy right here. And this guy, he's a product of the market. In this video, I'm going to try and demonstrate to you a little bit what the market does to traders. And again, guys, I'm focusing more on short-term day trading here more than anything. Okay, guys, so, on this screen here, we're looking at NASDAQ, and this is a market that has a lot of tendencies to it, and I honestly think this market moves the way it does due to the behavior and the greed of traders. I'll demonstrate a certain pattern that happens a lot. So let's say the market's in a trading range. So this trader here, he's a bull. He's bullish. And he has good reason to be a bull. The market's in an uptrend. He's been trading well. He's following the market and whatnot. Okay, he buys the market potentially on a pullback. And then what happens is he gets paid. He takes a profit on an upswing. So that's a great thing. But then what happens, this is a very crucial moment, is that the market does this. And in his head, this trader, he's thinking, he's like, wow, if I could have held this trade for 20 more seconds, I would have been about 10 handles richer than I am now. That thought process right there is the thought process that is going to end up with this trader going broke in a short amount of time. Because he is now shifting his mentality that was originally geared towards consistency and just getting paid consistently. He's now gearing it towards, man, if I would have held this trade longer, I would have had a huge winner. That is absolutely the wrong approach. This is what the market does to traders. It tries to convince traders that they need to hold on to their trades longer than they actually do. So that's one common pattern. Now, every time he takes a profit and then the market continues in his favor without him, he's going to be just a slightly bit more tempted in the future to not pay himself. And over time, this will add up to the point where now the market is going in his favor and he is not paying himself. And then what happens is it goes straight for his break even. And then he says, all right, now the market's at my break even. This is for sure a stop run. And then instead it just goes for his stop. So every time the market gives him, 20, 30 ticks of profit, instead of getting paid, he's letting it come back to break even. This is a tendency that happens in the marketplace. The market does this. The market is designed to promote traders into becoming more greedy at times, especially when it comes to getting paid on trades. So that's an example of how a trader can go from a mentality geared more towards consistency to a mentality geared more towards wanting to get a big winner all the time. I've been a product of this, and that's definitely one way to go broke in trading. So the next thing I want to cover, which again is related to a similar thing, it's thinking about trade management. So most traders, when they get into a trade, they think like this: win or loss. Now, this right here is a losing mentality, simply because you're allowing the possibility for a loss. Now, all of a sudden, if you shifted your mentality to this, win or scratch, now what you're doing is you're limiting your losses even more. Basically, what you're doing is you're focused on, number one, keeping your entries more tactical, meaning that your entry point should present a win or scratch opportunity. And when the market gives you profit, guess what? You're ready to get paid pretty fast because actually you're comfortable scratching this trade if it comes back against you. This is how professionals think. This is how market makers think. All of a sudden now you're closing the door to losses. You're saying to the market, when I enter a trade, I'm looking for the trade to be on side almost immediately. That's how tactical I'm trying to be with my entry points. For example, you get into a trade and you're in profit, you're not even gonna let that trade go offside. That's the idea of win or scratch. And what happens is when you get a winner, it's all about how much the market's going to go in your favor. And you just trail your profits with the market going in your favor. That's the idea, basically. So some sessions you might end up with smaller winners. Some sessions the market's running and you just end up with these huge winners. The point of it is you're focused on managing your risk based on your entry point. But once you're in the trade, if you're in a profit as soon as you're in the trade, why would you even let that go offside? That's the way of thinking that you got to have, right? So for example, you get into the trade here, the market goes in your favor. Most traders, they have a stop down here. They're going to let it come all the way down to close to their stop, and then they're going to let it come back to break even, and then they're going to think, all right, now I'm going to hold the trade because I think it's going to come back here. The problem with that is if you're a scalper and you did this, you are not nimble enough. What a professional would do in that case is if you're long here, you have a stop down here for an emergency. If you get filled on a sweep and then the market goes in your favor, guess what? You're trailing your stop as it goes in your favor because you want to lock in that profit. Whereas a retail trader or a gambling trader or a trader who's always looking to get runner trades, what happens is when the market goes in their favor, they're going to keep their stop here. Maybe they'll move their stop to break even, but still, what happens often is the market will sweep back down, take out your stop, and that's the end of the story. You just gave back all this profit. Now, why would you do that? If you have a winner and the market's paying you, you got to get paid. That's the whole point of this. So it's about shifting your mindset here. You know, guys, I'm making this video because I need to hear this myself. I'm trying to shift my mentality from the retail trader mentality, which is win or loss, and you're comfortable losing, to the win or scratch, meaning that as soon as the market gives you a profit, you start trailing that thing and you just get it. It doesn't matter if the market pays you, 20 ticks, 30 ticks, you just get paid. That's what good traders do. They focused on getting paid. And guess what? If the market moves in their favor immediately, depending on how they choose to manage the trade, normally what a smart trader would do is they will pay themselves on a part of that position and then let the rest ride. This brings us to another problem, which is the fact of trading only one contract is probably one of the hardest things psychologically to deal with because you're a one lot trader. So you get filled on this sweep down and the market swiftly moved in your favor. Great, good job. You got a good fill. Now you have two choices. Either number one, you hold the trade and expect more profit, or number two, you trail a stop as the market gives you profit. As soon as the market turns, you get out. Now, out of those two choices, it may seem obvious which one is the right choice, but let me tell you, over time of repeating this over and over again, let's say you do this 10 times, all right? And every time you paid yourself, what happened was the market shot up in your favor every time. Every time that happened, I'm telling you, there's a subconscious buildup of frustration that you could have had more profit, that you left profit on the table. If you're a one lot trader and this happens to you, you need to get used to the idea of leaving profit on the table because you need to shift your mentality towards a trader who is focused on getting paid consistently instead of being a trader who wants to get huge winners all the time, which is not the way you make money consistently in trading. Absolutely. See, that's the problem with being a one lot trader. If you were a three lot trader, now it's a lot easier because say you get filled on a sweep down, market shoots in your favor. Now guess what? You can trail a stop on two of your three contracts. You get paid here, right? Now you got one left. Now what you can do is you can ride that last contract out. Just put your stop at break even and just go and sit back and ride it out. You just got paid on the majority of your trade and you're comfortable letting the last bit of it run because let your winners run. Why not? You don't know if it's going to go to infinity, right? And this happens a lot, especially on trend days, right? If you have a good entry and a good trade, you absolutely need to pay yourself. But then if you have the ability to leave a runner on, you may as well do that because there are days where the market just runs and runs and runs, right? So this is the kind of stuff I'm exploring, and really it requires a mindset shift from being a win or loss trader to a win or scratch trader. Just think, my goal today is to get paid consistently. I don't care how much I get paid. What I do care about, if my entries are spot on or close to spot on, market's giving me profit, I'm locking it in type of thing. I'll go into conditions a little bit because there are certain trading conditions where, for example, the market's a little bit slower. I don't like this a lot, but there are certain trades that require this type of assessment. It's this assessment right here. It's when the market has been in a trading range and it looks like it's about to make a rotation up. What you're doing is you're getting ready to go long on a pullback. You buy the pullback, right? And then what happens is the market goes up, then it comes back to test, and then it goes for the move. Now, what traders will often do is they will buy it, and then they'll put their stop at break even right away. It comes down, tests their break even, and then it flies after that. So there are certain conditions that require you to be a little bit more patient with managing the trade. I've definitely experienced this a lot. Now, that being said, one important nuance is the velocity of how the market is approaching your price. All right, now I'm not going to tell you exactly what I look for, but I will say that the velocity of how the market approaches certain areas, that's a very important nuance, and I'm just gonna say that, and that's it. Okay, the last thing I wanted to talk about in this video is about stop orders and emergency stop orders. In a couple of videos I made, I talk about the difference between stop orders and stop limit orders. Now, we're talking about stops because we need an emergency stop. A trader needs an emergency stop because you never know what could happen. There could be some days where you're just not reading it properly, your entries are a little off, and what happens is you bid, the market goes straight for your bid, then straight for your stop. And that happens, right? You can't avoid that. Some days the conditions are just not ideal for what you're looking for, or you're just not seeing it properly, you're not reading the volatility properly, type of thing. This happened to me yesterday. I'll share with you an experience. So I was trading an option on Interactive Brokers platform. And normally what I had going on was a stop limit order on that option. And that is my emergency stop. It's a tight stop. I'm not going to tell you how much, but it's tight. I was using a stop limit order with a 3-cent offset, meaning that let's say my stop is at 75. The stop triggers at 75. I will allow a fill as low as 72. That's basically what a stop limit order is with an offset. So the stop triggers, then it submits a limit order 3 cents lower. Now think about this for a second. What happens if, for example, you got your stop here, the market triggers your stop, but then the market moves so fast and you're trading a slightly less liquid product, like an option, for example. The market moves so fast it skips your stop and you're stuck in a trade now down 2 times your managed risk because you used a stop limit order. That's the problem with stop limit orders. Since this experience, it had to happen to me a few times before I finally said, listen, I'm never using a stop limit order again. I'm always using a stop. This is related to options trading because in futures, there's no penalties for using a stop. The thing is with options, if you use a stop order, it triggers a market order, which is a liquidity taking order, which you will get charged more commission for. So the average commission cost in an option contract would be maybe about 65 cents. If you bought or sold at the market price, all of a sudden you'd pay $1.50 now. So that's just an example of how the commission cost would be higher. Problem is, you have to now weigh this out. Number one, higher commission cost, but you get out of the trade immediately. And number two, lower commission cost, but there's a risk that the market does this, it skips your stop, and now you're in a trade, a sitting duck, down 2 times your managed risk. And you do not want to be in that trade, trust me, especially if you're trading big dollars. Since this moment right here, I do not use stop limit orders, only stop market order. And this is for an emergency stop. I'm a believer that day traders need to have an emergency stop. Some will say, well, what if the spread between the bid and the offer is so wide? Well, don't trade that. Don't trade products that have widespread bid and offers. Just stick to tight markets. That's why futures are so advantageous. Spreads are often very tight, so you don't get any slippage. Now, if you do want to trade an option, just find the option with the tightest spread. All right, guys, if you enjoyed the video, leave a like on the video and subscribe to the YouTube channel. Don't forget to leave any questions in the comment section below. I will catch you guys later. Take care. Bye.